Variable overhead variances. In this class, we'll try to finish off variable overhead variances as well as fixed overhead variances, sales and sales margin variances, and some comprehensive illustrations. Material cost variance, like we have what? Labor cost variance. Similarly, we have variable overhead cost variance. The formula remains same like for all the three. Okay. Standard cost minus standard variable overhead minus actual variable overhead. Similarly, material price variance similar to labor rate variance, which is equal to variable overhead expenses variance. Expenses variance. Rate variance means standard rate minus actual rate you will take. Similarly, standard variable overhead per hour minus actual variable overhead per hour multiplied with actual hours. Now, material quantity variance, like labor efficiency variance, here variable overhead efficiency variance. Okay. This is related to the time consumption. Standard hours minus actual hours into standard variable overhead per hour. You just forget this one. So only these are the formula we have. You can compare only when the outputs are same, but here budget and actual outputs not same, so you cannot compare. You now find out the standard for actual output. For 25,000 units, variable overhead being 2.5 lakhs, for 20,000 it should be how much? 2 lakhs. And for 20 it is 110, then for 25 125 means for 20 it should be 1 lakh. So we got the variable overhead, standard and actual. Okay, standard variable overhead being 2 lakhs, actual being 2,60,000. Hours, standard hours being 1 lakh, actual hours being 1,25,000. Output, of course, these two same. Okay, for 20,000 units of output. 20,000 units of output. Clear? Now, in case of variable overhead cost variance, it's the difference between standard and actual cost. Standard cost is 2 lakhs. Actual cost is 2,60,000. You spend around 60,000 excess, then that 60,000 is named as adverse. The 60,000 is adverse. Variable overhead expenses variable overhead per hour basis. You can calculate hour basis per hour, expenses per hour. 2 lakhs for 1 lakh hour means 2, and 2,60,000 for 1,25,000 hours. 1,10,000 hours, sorry. This is 1,10,000. Then this value being 26 by 11. Standard variable overhead per hour being 2 minus actual variable overhead being 26 bar 11 into actual hours, in this case being 1,10,000. 1,10,000. $40,000 adverts you are getting, right? So you'll be getting 40,000 adverts. Efficiency variance, standard hours being 1 lakh, Actual hours being 1,10,000. You consumed 10,000 hours excess. And standard rate being 2 rupees. 10,000 hours consumed excess into 20,000 rupees adverse here. 20,000 adverse here. So for variable overhead variances, only these three variances we have. We don't have the mixed variance as well as the sub-usage or yield variance not available here. All the variable overheads are grouped and stated as single variable overhead. So we don't have the mix and yield here. Shall I move on to the next one? Next, we'll move on to the fixed overhead variances. In case of fixed overhead variances, we supposed to calculate around 6 different variances. Okay. We have to calculate 6 different variances. Okay. Fixed overhead variances. Let me finish up first the basic variances. SV Limited has furnished the following data. Production in units budget 20, actual 22. Fixed overhead budget 30, actual 31. In case of fixed overhead, we need to have 3 overheads here. One is as per the budget. Another one is actual cost we incurred for fixed overhead. Another one being standard. Standard, I mean here is the fixed overhead meant for the actual output. Okay, standard. So output. Okay. So here 20,000 units were produced. For that, our overhead being 30,000. We estimated we will spend around 30,000 rupees for an output of 20,000. But actual production being 22,000. Actual production being 22,000. Then overhead incurred for the actual production here being 31,000. If you want to compare, how can you compare? You can compare based on the actual output only, no? What about the overhead we estimated for the actual output of 22,000? For 20,000, 30,000 spend means for 22,000 it should be 33,000. 33,000. Is that clear? Now, number of working days being 25, 27. These are the other details. Fixed overhead per hour. Okay. Fixed overhead per hour. 1 rupee in case of budget. Actual hours worked being 31,500. So I have taken all these details in a small simple format. Now this information is more than enough to calculate all the variances related to fixed overhead. C, budget and actual and standard. You can very easily connect these two to get the three overheads: 30,000, 31,000, 33,000. Come on, tell me, what is the fixed overhead expenses variance? Means cost variances. Fixed overhead, cost variances, or simply fixed overhead variances. Standard fixed overhead minus actual fixed overhead. How do you get this? The normal. Usually we will comparing the standard and fixed only, means actual only. What is the actual here? What is the actual here? Actual fixed overhead here being 33,000, standard being 33, sorry, actual 31, standard being 33,000. Actually, standard is higher than the actual. It means we saved, so 2,000 rupees favorable. Okay, 2,000 rupees is favorable. Clear? Now, interesting component here being fixed overhead expenses variance. Fixed overhead expenses variance. And what is called fixed overhead expenses variance here? Okay, the expenses variance is nothing but the difference between budgeted fixed overhead and actual fixed overhead. You budgeted 30,000 rupees, but we incurred 31,000. This is the uniqueness applicable only for the fixed overhead variances, not other cases. You estimated 30, but you spent 31,000 rupees. You spend 1,000 rupees excess, then it is adverse. This one being 2,000 favorable, this one being 1,000 adverse. Very interesting. Now listen. Actually, you produced 22,000 units at a cost of rupees 31, but for the same 22, standard fixed overhead should be 33. No. If I ask you the expenses variance, I never bother about the standard, I bother about budget. Why? This is the uniqueness of the fixed overhead, where all other cases will be totally different. Why? You cannot link the overhead with the output in case of fixed. Rent for Singar Academy may be 10,000 rupees. If I get only one student, still I have to pay 10,000 rupees. If I get full loaded, also I have to pay 10,000 rupees. I cannot say that I paid more because I get more students. No, it's not possible. But the printing and the distribution of the material cost may be varying as per the students admitted. Hope you will be now able to understand the difference. So because of that reason, whenever I talk about the expenses variance, what is my budget? What is the actual? Irrespective of the commodity produced, we will not link with the output here. I thought I can spend only 30,000 rupees for the fixed overhead as per my commitment, but I actually spent 31,000 rupees, 1,000 extra adverse. Then, third one is all about, what about the volume, sir? What about your volume for your budgeted fixed overhead? You thought you can manufacture only 20,000. This is your budget. But you produced how many? 22,000. 22,000 units were produced. So, increased volume. You produced more than the thing, so it's favorable only. It's favorable. Is that clear? Now, that fixed overhead volume variance is related to standard fixed overhead minus actual budgeted fixed overhead. I budgeted for only 20,000 units. Estimated it may be 30,000 rupees, but this fellow has produced 22 within the same time. For the 22,000 as per my standard cost, it should be 33,000. So I spend the same 20,000 units spending, but produced 22,000. So excess 2,000 units produced now at the standard value. What is the gain I get? If I am producing more units than the budgeted and unfavorable, else adverse. So here I get 3,000 excess units, so favorable. I can draw this as a diagram here. See, the difference between actual and standard will be called as fixed overhead variance. Expenses means I never bother about the output. What I budgeted, what I actually spend will be expenses variance. This is called expenses variance. And budget is the actual output, means budgeted output. Standard is for the actual output. If the actual output is higher, then it's favorable. So these two are linked for what? Volume variance. You can very easily remember this as a story. Okay, a monkey cap also you can draw. Okay, three variances are over with this diagram. Simply you can remember. Clear? Three diagrams: budget, actual, standard. So you have to connect these three: budget, actual, standard, to find out three variances: fixed overhead variances, fixed overhead expenses variance, and volume variance. Whenever we are talking about direct variances, it's always the difference between actual and standard. But whenever it is all about fixed overhead expenses variance, the expenses variance, we never bother about the output. So we have to bother with what? Budget and actual expenses only. But volume means budgeted volume as well as standard volume. Standard means actual volume we produced. For the actual output, what could be the budgeted price and what could be the budgeted actual spending we have planned. So the difference between these two is the volume variances. If you add up these two, then you will get this. Volume variance plus expenses variance is equal to what? Fixed overhead variance. Clear? Thereafter, we need to incorporate three more additional variances. I will now easily explain and link with the existing knowledge so that you will be able to understand this easily. What is that? Come on, tell me. Fourth one. Fixed overhead efficiency variance. Come on, tell me. What's the formula for efficiency variance? Efficiency means consumption of time. If you are consuming lesser time to produce, then you are more efficient and your result will be favorable, else adverse. What is the formula for usually efficiency variance? It's quantity variance is equal to labor efficiency variance. It's equal to variable overhead efficiency variance, which is equal to fixed overhead efficiency variance. Also means weighted to the output or hours. So standard hours minus actual hours into standard fixed overhead per hour. Okay, per hour. How can you calculate this one? How can you calculate this one? Okay. Now, where is the standard hours? Here, fixed overhead being 1 rupee per hour, total fixed overhead 30,000. It means budget hour being 30,000 hours, isn't it? I have calculated this way: for the output of 20,000 units, the budget hours being 30. But this one is what? This is 31,500 is the actual, right? Yeah, sorry. Actual 31,500. Come on, tell me. For 20,000 output, 30,000 hours needed. For 22,000, what is the hours required as per my standard? Do the cross multiplication, it should be 33,000 hours at the rate of rupees 1. Now, what is the actual hours? Actual hours being 31,500. So, actual hours being 31,500, standard hours being 33,000. So, you have to compare the difference between these two. Okay, here. Standard hours being 33,000 hours taken for the actual output as per the standard input. Actual hours taken for the actual output 31,500. And standard fixed overhead per hour is already calculated, which is 1. So you actually consume 1,500 hours lesser than it's favorable. So 1,500 favorable. Hope now you'll be able to understand very easily the fixed overhead efficiency variance. Clear? Next. Fifth one is all about calendar variance. calendar variance. Okay. What is called calendar variance? What is called calendar variance? In a month, the working days may be 20 days or 25 days. Right. What happens in case of February and January? January we may have lots of holidays. February default 28 days. Already 3 days has gone. So what happens here? You thought you may work for 25 days. But suddenly a non-holiday month came where we worked 27 days. If you are working for additional days, will you pay more rent? The rent will be the same. Month on month, if you are paying rent being 1 lakh, you are paying 1 lakh only. Your fixed overhead remains same. It will not be connected with the number of days you work. If you work for 10 days also, the rental will be the same. If you are working 2 days extra, you are not going to pay extra rent. If you are working more than the budgeted days, then it's a savings for you. If you are working less than the budgeted days, it's actually loss for you. You can decide here. Come on, tell me. 25 days is estimated, but you work for how many days? 27 days. So you worked better, definitely favorable. Actual days you work minus standard means budgeted days. Budgeted days multiplied with standard fixed overhead as it is for the days, you have to calculate for the days. Okay. We worked 2 days excess. So if you are working 2 days extra excess, then it's favorable. So 27 minus 25. Standard fixed overhead per day, in this case being standard fixed overhead. Okay. 30,000 rupees is for 25 days divided by 25. Then per day maybe, come on, 30,000 divided by 25 per day being 1,200 is multiplied with the 2 days, 2,400 favorable. You get this favorable. Is that clear? Good. And see, if I tell you, if you work around 25 days in a week, in a month, if you study for 4 months, you will pass the examination. But as per my statement, for conservative measure, you worked 26 days every month and 4 months you worked, but you failed. Then what happens? You come and complain me, sir, you told me work for 25 days, I worked for 26 days, still I failed. Okay, most of you are laughing. Yes, sir, really true, sir. Now, I thought for the 25 days, every day you will work for 8 hours. But you work for 26 days, every day you work for only 2 hours. Then will it be logical? You are not utilized your capacity fully. Same. This is called capacity variances. For 25 days, I thought you will work for 30,000 hours. That's what about your capacity. 30,000 divided by 25 means per day. How many hours you are working? 2,000, 1,200. 1,200 hours you are working. That's what about my expectation. You told me, sir, I worked for 27 days. 27 days means 27 into 1,200. What? Huh? 32,400 you should work. But actual working is only 31,500. Days increased, but you are not working completely. So how many hours you reduced now? 32,400 is the capacity you have, but you work only 31,500. So if you work lesser, then it's adverse. How many hours you work lesser? 32,400 minus 31,500. 9 hours you work lesser. So for 9 hours, cost will be considered as capacity variance, right? Sixth one. Capacity variance, or it may be named as revised capacity variances. Fixed overhead calendar variance, fixed overhead capacity variances. Capacity variance. How can you calculate the formula being? What's the formula here? Actual hours minus revised budgeted hours. Revised budgeted hours is nothing but hours you need to work for the actual days. Actual days. As per your budget, you work for how many hours a day? 1,200. So as you work for 27 into 1,200 should be the revised budget hours, but you work only 31,500 multiplied by standard fixed overhead per hour. As it is being for hour, you can get the value for hour. So actual hours being 31,500 minus revised budgeted hours. Okay, 30,000 is the budgeted hours for 25 days. For 27 days, what should be this? Come on, you can do the cross multiplication. Overall, fixed overhead per hour being 1. So it should be 32,400, but you worked only 31,500. You worked almost 900 hours lesser per hour. 1 rupee means 900 adverts. 900 adverts. If you add up these two, capacity and calendar variance, you'll get what? Fixed overhead efficiency variances. 2,400 calendar variance being favorable, capacity variance 900 adverse. If you are adding these two, then the ultimate fixed overhead efficiency variance in this case is only 1,500 favorable. Clear? So that's all. With that, we have completed the fixed overhead variances also. Very rarely, variable overhead variances may be asked in the examination because you are not going to study it separately. It's similar to normal labor efficiency, labor variances. Only 3 variances there. Very often we can expect the questions from the fixed overhead variances where it's very easy because 6 variances, 2 marks each, 12 marks may be expected for the CMA students. Even at final, one student got this for 12 marks illustration. I still remember one of my students. He completed this question in a matter of 7 or 8 minutes. 12 minutes, 12 mark guaranteed in 7 or 8 minutes at final level. Such the easiest one. Clear? Hope you'll be now able to understand. Shall I go for the next one? Yeah. Let's move on to the next one. Online students, come on, text me. If it is clear, we'll move on to the next one. Now, so what are the predominant things you have to finish off? Budget. I'll finish up the basic calculations. What are they? Budget, actual, standard. Working days being 20, 22. Man hours being 4,000 and 4,200. Fixed overhead 2,400 budget, actual 2,500, output 800. But actual output is not 800, so you have to recalculate the entire standard details for, sorry, budgeted details for the standard output, means actual output. For 800 output, fixed overhead is 2,400. Then what could be the fixed overhead for 900 output? 2,700. So these are the things that are calculated here. 2,700. 4,000 hours required for 800 units means for 900, 4,500. Am I right? These are the main details we need. Then we can calculate all the things easily. Get back for the complete calculations. The relationship between these two, fixed overhead variance. This will be called expenses. These two are called volume variance. Very simple. By seeing these 3 numbers, you can finish off 3 variances just like that. Just like that. Yeah, tell me. Fixed overhead variance is equal to standard fixed overhead minus actual fixed overhead. And fixed overhead expenses variance being the difference between budgeted fixed overhead as well as actual fixed overhead. I just gave the logic why we have to take the budget sometimes, standard sometimes. and fixed overhead volume variance based on the output, right? So then standard fixed overhead, and we compare only the output, not the actual. So budgeted fixed overhead and standard fixed overheads are taken here. Now standard fixed overhead 2700, actual fixed overhead 2500. This one 200 rupees you saved, favorable. Budgeted fixed overhead 2400. So I am going to take the expenses variances. Budgeted being 2400, actual being 2500. You thought you spent 2500, but you spent 2400, but you spent actually 2500. If you inquire why did you spend more rather than 2400, you spent 2500. What will be the reaction? Sir, we produced more units. Is that argument correct? Definitely not so, because this fixed overhead is always not linked with the output. Whether you produce or not, you have to incur this. So we cannot stand with the argument given by the others. So you directly compare the difference between the actual and budget. The difference in this case higher by 100 is adverse. Standard fixed overhead 2700 rupees worth the items produced, but 2400 rupees worth the item estimated. What is the estimation you planned? You need to produce 800 rupees worth, otherwise 2400 rupees worth output you planned. But what is the production? 2700 units output. So your production is increased, otherwise the volume is higher. If the volume is higher, then favorable, so 300 favorable. If you add up these two, you'll get what? Fixed overhead variances. Thereafter, we have three more variances. One is efficiency, another one is calendar, another one is capacity variances. That's all. Come on, tell me. Fixed overhead, efficiency variance. Efficiency variance is nothing but the consumption of time. Standard hours, how many hours you plan to consume? What is the actual hours consumed multiplied by fixed overhead per hour? Which fixed overhead? Standard fixed overhead per hour. Okay. Yes, standard hours. Standard hours being 4500. Actual hours only 4200. Within 4200 hours itself you produced. Actually, you estimated 4500 hours required for producing 900, but you produced in 4200 units hours itself. What is the standard fixed overhead per hour? 2400 for 4000 hours. 2400 for 4000. 60 paise. Now 60 paise into 300. 180 favorable. 180 favorable. Then fixed overhead efficiency variance is over. Next we will go for the fixed overhead calendar variance. Calendar variance. This is all about the number of days you work is higher than the budgeted days. Then you are favorable. Okay. Actual days minus budgeted days. Multiplied with standard fixed overhead day basis. Actual days being 22. Actually, you worked better. You thought you can work for 20, but you worked for 22 days. Standard fixed overhead per day. So standard fixed overhead. Fixed overhead 2700 for 400 for 20 days. 2400 for 20 days. 120 per day for 2 days. It is 240 favorable. 240 favorable. Clear? Then we will move on to the next one. Fixed overhead capacity variance. Capacity variance. What is the capacity? Okay. You worked for 4200 hours, but 4000 hours can be workable for 20 hours, 20 days. But you have worked for 22 days means how many extra hours you can work for? So 4000 is for 20 days, but actually you worked for 22 days means what could be the budgeted hours you can work for this month? 4,000 into 22 divided by 20, 4,400 hours. You are capable of working. Your capacity is to work 4,400, but you work only 4,200. Multiplied with, oh, formula I missed. Okay. What is that? Actual hours minus revised budgeted hours multiplied with standard fixed overhead per hour. Standard fixed overhead being 60 paise, already we calculated here. So 2,400 divided by 4,000, 60 paise. Then what's the final value? 120 adverse. If you add up these two, you'll get efficiency variance. Okay, I think somewhere mistake is there. Capacity variance correct. Calendar variance 240 favorable also correct. Okay.
Capacity adverse
Okay. Okay. Capacity being it is adverse only, right? Okay, you're not getting here, so leave it. I will explain this. Here you can make the comparison the other way. Sorry, I just stand corrected. If you add up this one, and you'll get this one. 240 favorable, 180 favorable, adverse 120, you'll get the volume variance. Volume variance is segregated. Last time also I missed, no? Yeah. Add these two, then you'll get this one. Is that okay? 2,400 favorable, 900 adverse, 1,500 favorable, 1,500 favorable, you'll get 3,000. The fixed overhead volume variances are the combination of the three. Okay. Surprisingly, last illustration, if I do adding this, I'll get this, but it's not necessary. Hope now you'll be able to understand. Yeah. Make a note of it. Make a note of it. So online Kishore is present in YouTube. Okay. So YouTube students also chat with me to clarify your doubts. Clear? Shall I move on to the next one? Now, one more illustration to master in this topic. Finish off the table first of all. ABC Enterprises has normal monthly machine hour capacity of 100 machines, working 8 hours per day, 25 working days in a month. So budget. Days. How many days? 25. What about the hours? 100 into 8, 800 into 25. Come on, tell me what is the budget hours in a month? Hmm? 20,000 hours. Very good. Okay. The standard time required to manufacture 1 unit of the product is 4 hours. Standard time per hour be per unit. Okay. 4 hours needed. Then 20,000 means what about the output? 5,000 units. Isn't it? For producing 1 unit, we are in need of 4 hours. For 20,000 hours, we can produce 5,000 units. The budgeted fixed overhead being 1,50,000. Fixed overhead. 1,50,000. In a month just concluded, the company worked for 24 days, an average 750 machine hours. So actual 25 days work. So in this 24 days, in this case we worked with less than number of days, then definitely calendar variance is adverse. 25 days into 750 machine hours, what is the total value? 4,500, 18,000. 18,000 hours worked actually. Production was 4,500 units. The actual fixed overhead being 1,60,000. We got all the details. We got all the details. Better you can have one more column for standard. Standard. For standard, output should be same. You have to calculate the fixed overhead required for producing 4,500 units, hours required. Okay. For 5,000, 15,000 means for 4,500, 13,500 will be the fixed overhead we estimated. And for 5,000, 20,000 hours needed. Sorry, 1,35,000. Am I right? 1,35,000. 5,000 output can be produced in 20,000 hours. Then 4,500 means 18,000. 18,000 hours. Am I right? Surprisingly, hours taken is same. Hours taken is same. Now come on. We can try to find out all the variances here. This will be called what? Fixed overhead variance. This will be expenses variance. And this will be volume variance. Volume variance. Okay. Fixed overhead variance is equal to standard fixed overhead minus actual fixed overhead. Standard fixed overhead being 1,35,000. Actual fixed overhead being 1,60,000. 25,000 you spend more, so adverse. Fixed overhead expenses variance. Okay. Budgeted fixed overhead minus actual fixed overhead. Budgeted fixed overhead in this case being 1,50,000. Actual fixed overhead 1,60,000. You spend 10,000 rupees higher, so adverse. Fixed overhead volume also lesser. No, we estimated that we can produce 5,000, but actually we produce only 4,500. Standard fixed overhead minus budgeted fixed overhead. Budgeted fixed overhead. Standard fixed overhead being 1,35,000. Budgeted fixed overhead being 1,50,000. 15,000 adverse. Okay. If I add up these two, then I'll get this value. Second set. This is the first set. Second set. fixed overhead efficiency variance, standard hours minus actual hours into standard fixed overhead per hour. Standard hours here being 18,000, actual hours also 18,000, so there is no variation in consumption of hours. Per hour rate being how much? 15,000 for 20,000 hours, then 1,50,000 divided by 20,000, per hour rate being 7 rupees 50 paise into 0 0 only. Efficiency variances. Then fixed overhead calendar variance. Fixed overhead calendar variance. Calendar variance. Budgeted days or actual days minus budgeted days. Actual days is higher than happy. That's why I am putting the value here are there to get the positive value. You can write the formula budgeted days minus actual days also, but you have to guess properly whether it's adverse or favorable. If the number of days you work higher than the budgeted, then it's favorable. That's all. Into fixed overhead per day. Standard fixed overhead per day. Actual days 24, budgeted days 25. You worked lesser, 24 minus 25, adverse 1 day. Standard fixed overhead 1,50,000 rupees for how many days? For 25 days divided by 25. Per day fixed overhead being 6,000 into 1, 6,000 rupees adverse. 6,000 or? Yeah, 6,000 adverse. Then we have to find out what? Fixed overhead capacity variance. Capacity. In case of capacity variance, actual hours you worked, revised budgeted hours multiplied by standard fixed overhead per hour. Actual hours you worked here being 18,000. Revised budgeted hours in this case. Revised budgeted hours. 20,000 hours you estimated for 24 days, 25 days. But actually you worked for only 24. Then what could be the revised budget hours? Then you can multiply with the standard fixed overhead per hour, 1,50,000 divided by 20,000 rupees. 20,000 hours. Come on, tell me what's the final value? $9,000 adverse. If I add up these three, I'll get fixed overhead volume variance here. Fixed overhead volume variance. Now we'll move on to the next one. So with that we have completed fixed variable overhead variances as well as fixed overhead variances also. We'll now move on to the next one, sales variances. Sales variances. This one also similar, but we don't have the yield variance here. Rest will be the same. Yes, come on. So quantity, sales price also given and cost is also given. If I calculate based on what? Sales. Then it is called sales variances. Okay. We have X and Y. quantity, budgeted quantity being 3000 and 2000, budgeted price per unit of output being 12 rupees, 18 rupees, budgeted sales in total 3000 into 12, 36,000, 2000 into 18, 36,000. You sold 5,000 units for 72,000 is your budget. Similar to what? Standard quantity, standard price, standard cost. I use the same format here. For budget, for actual, I have to calculate. For actual quantity, actual price, actual sales. Actual quantity being 3,200, actual price being 13, 1,600, price being 17, 4,800 units sold. 3,200 into 13, what is the sales value? 41,600. And 1,600 into 17, 27,200. Total 68,800. Yes, come on, calculate the variances here. Just similar to the material variance, you can follow the same here also. Tell me, material cost variance. Similar to, we have sales value variances overall. Sales value variances. What's the formula? Their standard cost minus actual cost, but in case of here, we don't call this being standard, it's a budgeted sales minus actual sales. What is the budgeted sales? For X separately, for Y separately also you can calculate. So 36,000 minus 41,600. For Y 36,000 minus 27,200. For X, actual sales higher by 5,600. Am I right? Come on, tell me. Adverse or favorable? Here it's favorable, right? So revenue. Until earlier we studied about the cost. If the cost is higher in actual, then it's adverse. Here sales is higher than the actual, means budgeted, then we are pretty happy. Be careful here. This is favorable. Similarly, for the sale of Y, the sale value is decreased. How much is that? Hmm? 8,800 adverse. If you add up these two, 3,200 adverse. What's the next formula? Come on, tell me. In material, we have material cost variance. The next one being material price variance. Then similarly here, what we have? Sales price variance. So very simple, right? You are not going to study this separately. Once you are master with the material labor variances, this is just like that you can finish up. Except in the case of fixed overhead variances, two different aspects are there. This will be same. Budgeted price or standard price minus actual price into actual quantity. The same will be taken here for X, for Y. Budgeted price being 12 and 18 for X and Y. For other one, it is 13 and 17. Actual quantity in this case being 3,200 and 1,600. Come on, tell me. You fix the sale price for X 1 rupee higher than the budgeted. So you are pretty happy. It's a revenue increase. 1 into 300, 3,200, 3,200 favorable. Here you sold lesser value adverse. So 1,600 into 1, 1,600 adverse. Ultimate value being 1,600 favorable. What is the next one? Material quantity variance. Here, similar to that, sales quantity variance or sales volume variance. Quantity represents volume. No. What is the volume of quantity you sold? So here I named this being sales volume variance. What's the formula for quantity variance? Standard quantity minus actual quantity, same way. Budgeted quantity minus actual quantity into, there you will have the standard price. Similarly, here also standard price for X and Y. Budgeted quantity being 3000 and 2000. Actual quantity being 3200 and 1600. 1600. The standard price in this case being 12 and 18. 200 for X 200 rupees quantity sold higher. If you are selling more quantity, you are pretty happy. 200 into 12, 2400 favorable. But in case of Y, almost 400 quantity you sold lesser. 400 into 18, 3200 adverse. What is the ultimate value if you are adding these two? 800 adverse. Huh? Oh, 7200. 7200 adverse. 400 into 18, 7200 adverse. What is the final value? 4800 adverse. If you add up these two, you will get this value. Cross check. What is the next one? Material mix variance. Similarly here, sales mix variance. They revised standard quantity. Similarly here, revised budgeted quantity minus actual quantity into standard price. So you have to find out the revised standard quantity or budgeted quantity separately. In case of revised budgeted quantity, input should be same. Input should be same. But sales mixes should be as per the budgeted mix. In your total sales, X corresponds 3 share and Y corresponds 2 share. If you plan to sell only the input of 4800, how much should be X, how much should be Y? 2880 should be X and 1920 Y. But usually in all the cases, material and labor, we have input, loss and output. But here we don't have output and loss, only one item. From this, it is very clear we cannot calculate yield variances. As we are not able to calculate yield variances, substitute will also be there. What's that? Sub-usage. If you are not having the yield variance, you can depend on sub-usage variance. So here also you can depend on sub-usage variance. We cannot use the yield variances here. Yeah, come on. For X and for Y. For X and for Y. Revised budgeted quantity 2880 for X, for Y 1920. Actual quantity being 3200 minus and 1600. Standard price already we are given 12 and 18. For X, actual is higher than it's favorable by how much? 3840 favorable. In case of Y, 576 adverse, right? What's the overall value? 1920 adverse. Then we'll go for the material sub-usage variance. Like we have sales sub-usage variance. In sales sub-usage variance, we have to take with the standard quantity minus RSQ, revised budgeted quantity. Standard or budgeted quantity? Budgeted quantity minus revised budgeted quantity. Budgeted quantity minus revised budgeted quantity. Usually, Standard represents for every unit. If I ask you to prepare a cup of coffee, or I want to prepare a coffee for all the students, around 20 students are present, then how can you calculate? Sir, for every cup, you need to take so much milk and sugar, 1 spoon, and 1 scoop coffee powder. If it is 20, you multiply with 20, that's all. If you are giving the details for one unit, then it's called standard. Such a case is not available for the sales. It's only already estimated one. We don't have the standard or other things also. So we directly take the budget. That's why I'm using the budget, but of course, logically, we can interchange this. So budgeted quantity minus revised budgeted quantity multiplied with standard price for X for Y. Okay. Budgeted quantity being 3000 minus 2000. Revised budgeted quantity already we know 2880 and this is 1920. Standard price being 12 and 18. Then the ultimate value here being 1440 adverse. Here also 1440 adverse. If you add the total value being 2880 adverse. If you add up these two, you'll get this value. Clear? Clear? See, in case of profit variance, rather than taking the sales price, we will take the profit. What is the profit for X? 2 rupees. What is the profit for Y? 3 rupees. Sales minus cost. In case of X actual, 2 rupees 50 by say 17 minus 14, 3 rupees. That's all. You can calculate yourself, so I can skip. Okay. So I have taken what? Profits as a base, profit value variance, profit variance, profit volume variance, then profit mix variance, profit sub-usage variance. Or sometimes the profit can be named as sales margin value variance, sales margin. P can be replaced with the sales margin also. You should not get confusions. Rest will be the same. So it's a repetition of the things what you have learned. That's all, not more than that. Hope you will be now able to understand the difference between profit variances as well as this one. Clear? You can see the solution here. That's all. There's a comprehensive illustration. Okay. Of course, these types of questions may be very rare for your examination and not applicable for CA Inter. You can stop here itself. So this is for CMA Group 2 students may have the idea about this. Those who have already joined can refer the other videos I shared to you in video form. You can go and see that videos also. It's a complete reconciliation. Profit and loss for the year ended 31st March 2023. 13,000 units sold for 5,20,000. The standard output for the year ended 20,000 units. Standard cost and standard profit are given here. During the period, actual material price was 4 rupees per unit. Labor was actually paid 2 rupees 20 paise per hour. It is also stated that 4 units are produced in an hour. Okay, 4 units can be produced per hour. Clear? Now, how many hours needed? 13,000 divided by 4. Tell me. 4 hours produced in an hour, then you have to multiply with 4. How much? 52,000. What about this one? 1,10,000 per hour, rate being 2 rupees 20 paise means what could be the total hours? Is it 50,000? 50,000 hours. 2 rupees 20 paise. 2 rupees 20 paise. This is what about the standard hours we estimated. This is the actual hours. Now you have to prepare all. Come on, let's start with the material variances. Tell me. Material price variance, standard price minus actual price into actual quantity. Actual quantity. What is the standard price per unit? 15 rupees. You can take the material component value 3.75 standard price. What is the actual price? 4 rupees per unit, right? 4 rupees per unit. Now, what about the units here? 2,12,000 divided by 4. 50? Two lakhs 18 divided by 4. 54,500. Why you are giving me wrong answers? Yeah. So 3.75 standard price, actual price being 4 rupees, actual quantity consumption being 54,500. Then what about the material price variance? 13,625 adverse. Material quantity variance, standard quantity minus actual quantity into standard price. What about the standard quantity? Standard quantity 4 grams needed per quantity. 54,500 is the actual quantity for 13,000 units. 4 grams needed. 52,000 standard quantity, but actual quantity consumption being 54,500 grams. And standard price here being 3.75. Then the final value in this case being 9,375 adverse. What about the quantity cost variance? Add up these two, that is the cost variance. You no need to calculate that one here. So first set is over. Similarly, now what you have to do? You have to calculate for labor variances. Yes. Tell me, what's the first one? Labor. Labor cost variance not required. We have to calculate the rest of the two. Forget about the mix and yield variances, only the basic two. Rate variance and efficiency variances. Labor rate variance, standard rate minus actual rate into actual hours. Standard rate here being 2 rupees per hour, actual rate being 2 rupees 20 paise per hour, actual hours being 50,000. So 0.2 excess into 50,000, 10,000 adverts, and labor efficiency variance, standard hours minus actual hours into standard quantity will be taken, standard hours being 52,000, actual hours being 50,000. So 52,000 minus 50,000 into standard quantity here being standard quantity. What is the standard quantity here? Efficiency variance, no, sorry. Standard hours to be taken. Standard rate, sorry, standard rate. What is the standard rate here? This is standard information, this is actual information. 2 rupees will be taken. 4,000 favorable. We got labor rate variances as well as efficiency variance. If you add up these two, you'll get what? If you add up these two, you'll get labor cost variances. You need to get the more detailed variances. Labor labor rate variance, labor efficiency variances. If you have the mix variance, then labor rate variance, labor mix variance, yield variances. These three is more than enough. The consolidated variance, you can just add and get the value. No problem here. So we have completed two set of variances. Material related variances over, labor related variances also over. Now what about the next step? You can calculate. This one is over, this one is over. Now we can calculate what? Direct charges variances. Direct charges, direct expenses variances. Okay. Direct expenses variances. Now, direct charges being 2 rupees. Okay. Actual production being 30,000 units. So direct expenses variance is equal to standard direct expenses minus actual direct expenses into actual quantity. Standard direct expenses being 2 rupees, actual direct expenses being 26,000 for 13,000 units means per unit also 2. Actual quantity 13,000, so 0. Direct expenses variance is 0. You no need to worry about this. Is that okay? One second. So direct expenses variance 0. Forget about this. We have been given factory overhead fixed as well as variable. Okay, fixed as well as variable. We'll finish off variable first. 36,000 for 13,000 units. Then here factory overhead variance being here 3 rupees. Okay. This office expenses is considered as fixed. Now, we'll finish up the variable first of all. Variable overhead, expenses variance, as well as variable overhead, efficiency variances. Formula for expenses variance being variable overhead, standard variable overhead per hour minus actual variable overhead per hour into actual hours. Efficiency, standard hours minus actual hours into standard variable overhead per hour. Clear? Hope now you'll be able to understand this. Clear? Now, 36,000, what is the standard hours or actual hours? Actual hours here being 50,000. So then variable overhead per hour being 36,000 by 50,000. Tell me the value. This is what about this actual. What is the value you are getting? 0.72. In case of standard, 3 rupees. How many hours required for every unit of production? 4 hours. 3 rupees for 4 hours means 0.75. Feed the data here. Standard variable overhead per hour being 0.75. Actual variable overhead per hour being 0.72. Then actual hours being 50,000 hours. So 50,000 into 0.03. 1,500 cheaper, so favorable. Standard hours being 52,000 minus actual hours being 50,000. Standard variable overhead per hour being 0.75. 1,500 favorable. So overall total being 3,000 favorable. Okay. Now, third set over. Next, last set is all about overhead related to the fixed expenses. Okay. Here, in case of fixed expenses, factory overhead also fixed, office expenses also fixed. As these two are fixed, you can simply club this two. Make it single. All the fixed overheads are made into single item. All the fixed variable overheads also made into single item. We don't have the mixtures and all. Similarly here, 2 rupees and 2 rupees, 4 rupees will be the fixed overhead per hour. Is that okay? In case of fixed overhead, what do you do? Fixed overhead, expenses variance, fixed overhead, volume variance to get what? Fixed overhead variances. For that budget, actual, standard. I need these three details. Budget, actual and standard. What is the budget here? Budget here being 4 rupees. Budgeted output we estimated here being 20,000. Is that okay? So budget information is for 20,000 units. So 20,000 into 4, 80,000 rupees is the budget for 20,000 units. Rupees and units. In case of actual, 37 plus 38, 75,000. Am I right? 75,000. But the actual output in this case being 13,000. Standard means for the same 13,000, what could be the budgeted fixed overhead? For 2018 means 80,000 means for 13,000. How many? What could be the price here? Value be? Come on, find out the value here. 13,000 into 80 by 20. 72,000. Am I right? 26, 52. Yeah, 52,000. And the difference between these two is expenses variance. The difference between these two is the volume variances. In expenses variances, budgeted fixed overhead minus actual fixed overhead. In case of fixed overhead, volume variances, standard fixed overhead minus budgeted fixed overhead. Is that clear? Now let's see. Budgeted fixed overhead being 80, actual fixed overhead being 75,000. Actually, you saved 5,000 rupees, so favorable 5,000. And this one, standard being 52,000, budgeted being 80. Actually, you lose. This is favorable here. Loss being how much? 28,000. 28,000 adverse. So we have calculated all the variances here. Still, we need to go for what? Sales variances. So I am going to calculate two variances here. Two variances here. One is okay. What is the sales price here? Get me the sales price. Sales price. I'm going to calculate two variances here. Let's see. One is sales price variance. Sales price variance is nothing but standard price minus actual price or budgeted price minus actual price into actual quantity. Then sales margin volume variance. Sales margin volume variance. Under sales margin volume variance, okay, budgeted quantity or standard quantity minus actual quantity into standard profit will be taken. It's not price, standard profit. While calculating the quantity based, price is taken, and for this one, profit is taken. These two are most important. Now, 5,20,000 for 13,000 units means per unit cost is 40, standard price being 42. Standard price being 42, but actual price is 40, you reduce 2 rupees adverse. As it is the revenue, if the revenue decreases in adverse, actual quantity being 13,000, the ultimate value here being 26,000 adverse. 26,000 adverse. And sales margin volume variances. Budgeted quantity, you estimated 20,000 units, right, in the top. Budgeted quantity being 20,000. Is that okay? So 20,000. Actual quantity is only 13,000. Number of units sold is very lesser. Multiplied with the standard price. The standard price being 42. Standard profit being 10. Then 7,000 into 10, 70,000 you gained lesser adverse. Okay, this is related to the profit. This is related to the sales price. Okay, this is profit. Don't get confused. This is price, sales price. Now, I'll post that the next slide. Almost I have got all the requisite variances. I'm going to prepare the reconciliation statement. A reconciliation statement. What is that? What is the standard profit, sir? 10 rupees per unit. We estimated 20,000 units can be saleable. 20,000 into 10, 2 lakhs. What is the actual profit? You made only 55,000 rupees. If the boss asking you why there is so much difference, you have to answer them, no, 1,45,000 rupees profit decreased. Now it's your duty to answer. Your duty is to answer. Answering that, from your budget, why this get totally changed, you have to answer, that is prepared as a reconciliation statement here. Statement of reconciliation. Statement of reconciliation. So you have to tell me the standard profit being 2 lakhs, standard profit being 2 lakhs, but your actual profit is only 55,000. Tell me the reason why you get so lesser money. Sir, because of the profit, sir, I lost around 70,000 rupees. I thought I can sell 20,000 units, but I sold only 13, almost 7,000 units sold lesser. Because of that, as per my standard profit, 10 lost. So, reason number 1, sales margin volume variance. Then I get only 1,30,000 rupees. This is called standard profit. This is budgeted profit, to make you understand. This is budgeted profit, not standard. What is called standard profit? For the actual output, what is the estimated standard profit? Your profit per unit being 10 rupees, the number of units sold being 13. For the 13, what could be the profit? 13 into 10, 1,13,000 is the standard. Standard is nothing but for the actual output, what is the profit? Okay. I budgeted for 20,000, but I didn't get. My budgeted profit reduced to 130 because of the number of units sold lesser. Okay, at least you need to earn 130 now. Why didn't you earn that 130, sir? Sir, I told you to sell at 42, but you sold for only 40. Even though I reduce my profit or adjust the profit for the actual unit sold, but the sale price also getting affected now. So minus, adverse is minus. Sales price variance, it is 26,000 adverse. It is 26,000 adverse. Clear? That's all. Okay, but your final answer is only 55,000, sir. Tell me the other reason. Sir, that 55,000 due to the other variances like material price variance. Material price variance. Is it favorable or adverse? Is it favorable or adverse? Material price variance being 13,625 adverse. Material quantity variance 9,375 adverse. Labor rate variance 10,000 adverse. Labor efficiency variance 4,000 favorable. Variable overhead expenses variances 1,500 favorable. Labor variable overhead efficiency variances 1,500 favorable. Favorable, no, sorry. These are favorable. Now, fixed overhead expenses variance 5,000 favorable. Sorry, favorable. Okay. Fixed overhead volume variance 28,000 adverse. Get the total of favorable 12,000, I think. Get the total of adverse 1,57,000. Ultimately 1,45,000 adverse. Favorable adjusted to adverse. So finally you will get this one. Is it adverse? 1 lakh? 51,000. Okay.
Total at 61,000.
61. Okay. Adverse 61. And after adjusting 12,000 rupees, what's the ultimate value? 40? 49,000. Adverse. Get me the final value. From 1,30,000, due to the price, we lost 26,000. Due to the ultimate cost variance is 49,000. What's the actual profit you're getting? You get the actual profit being 55. From the budgeted profit, you have to arrive the actual profit. Where from the budgeted profit, first volume difference will be removed. Sales margin, volume difference. Profit loss due to the volume. Next, profit loss due to the price change of the sales. Thereafter, all the variances will be added and subtracted based on the adverse and favorable. So you'll get the actual profit. This is what about the reconciliation statement. Clear? Yes, come on, make note of it.